I am Brian Francis. Today I'm joined by Adam Hutzel and Michelle Poston, also advisors here at InfiniTALKS. Welcome to this installment of InfiniTALKS, focused on planning by decade. This is version 2. For those in their 40s and 50s, today's presentation will be recorded. So in a couple of weeks, if you want to follow up on any of these concepts, it will be available on demand. So let's go ahead and get started. So today we'll be talking about a few things. I'm going to be covering strategic savings and tax planning. Adam's going to cover some educational topics and financial aid. And then Michelle will be talking about protecting your income, family, and your legacy. All right, so strategic savings and tax smart planning. This is my portion. I've got the most slides in today's presentation, so I'm going to be going a little fast to preserve some Q&A time at the end. So some of the items I'm going to be addressing is the concepts of Roth versus traditional contributions to retirement accounts. We're going to look at the investment of vehicles available that accept Roth and traditional contributions. We are going to run through a comparison of each side by side, and we're going to talk about some scenarios on how to choose which is best for you, both during the contribution phase and the distribution phase in retirement. We're going to touch on the concept briefly of Roth conversions, and we're going to talk about health savings accounts. Now, this is in no way going to be an exhaustive portrayal of these concepts in the interest of time and the potential of boring everyone to death. This is going to be a basic overview only. So what I'm about to tell you is likely just going to lead to more questions, but that's a good thing. You know, I want to give you enough to be dangerous, but not enough to be a danger to yourselves. So when it comes to utilizing these financial planning concepts, it's going to be really important that you consult with your advisor. So let's dive in. Now, if you're in your 40s and 50s, you're likely already acquainted with the concept of Roth contributions and traditional contributions. So with Roth contributions, you're paying your taxes ahead of time. And with traditional assets, you're going to get a tax deduction up front. So the full dollar amount that you contribute will go in. Now, you may also hear about traditional contributions being called pre-tax contributions. A better term might be tax deferred because these assets will be taxed as ordinary income when they're withdrawn in retirement. Roth contributions, on the other hand, might also be known as after tax or tax-free. This really isn't the case because you are paying taxes. You're just paying them ahead of time. So it might be better to refer to these as Roth assets being prepaid tax contributions and traditional contributions being considered tax deferred. Now, there's an antiquated term of after-tax contributions when it comes to 401ks, but folks in the 40s and 50s probably aren't going to encounter that. So we're going to skip over that portion. So let's talk about the account types. Roth contributions, typically for most plans that I see, are available in 401ks, 403bs, 457s, or thrift savings plans for the government. You'll notice that I've got it earmarked here as single account. So here's something I run into a lot. I'm working with a 401k participant, and they're adamant that they also have a Roth IRA. So after an amount of time trying to track down this Roth IRA, we realized that they're just making Roth style contributions to their 401k. So it's all in the same account. They're just earmarked as Roth or traditional. Now, when it comes to employer plans such as simple IRAs and SEP IRAs, up until recently, it was only available in the traditional format. Secure Act 2.0 is now making it possible to have simple Roth IRAs and SEP Roth IRAs. These will be two separate accounts. Again, it's relatively new. They're not available on every platform, but that is coming in the coming years. And then you've got your individual plans. So you've got an individual traditional IRA or an individual Roth IRA. These are accounts that aren't through payroll. You just make your own contributions on the side. Now, all of these are going to come with contribution limits. It's higher for 401ks, 403bs, 457s, and TSPs. Currently, the max is 23,500 of your own dollars can be contributed to these plans. If you're 50 and over, you can contribute another 7,500 in what's called a catch-up contribution. Now, recently, they've also added the super catch-up, but that only applies to ages 60 to 63, so we're going to skip over that portion today. The max contribution for a SEP IRA is $70,000. With a simple IRA, you can put in as much as 16,500 of your own money. With the catch-up, you can contribute an additional 3,500. Now, with these individual plans, your outside IRAs and Roth IRAs, the limit is currently 7,000 in contributions per year. That is for both combined. You can't contribute 7,000 to each. If you're over 50, you can contribute another $1,000 to each of those. Now, with the individual plans, there are earnings limits. So if you earn over a certain amount, you might be phased out of the ability to contribute to Roth IRAs altogether. Traditional IRAs, you can contribute no matter your tax bracket, but at some point you lose the ability to deduct those contributions. That becomes another animal. If you're in that boat, I would suggest you work with your advisor. Oops, I went a little too fast. Okay. Again, those are the account types available. So let's talk about when you might want to contribute to these vehicles. So during your accumulation phase, if you're in your lower earning years and your tax bracket's lower, it might be better to contribute with the Roth style. If you're in your higher earning years, it's possibly better to contribute to the tax deferred vehicle. Now I labeled it here, I highlighted possibly because there's something that we'll talk about in a few slides. Just because you're in a higher tax bracket doesn't mean that it is actually better to contribute the traditional style. Now, during distribution, in your retirement years, if you're in a higher income tax bracket and you need to draw some money, it might be better to draw from the Roth because they're prepaid taxes. You won't pay any additional taxes. In retirement, if you're in a lower tax bracket, you might want to draw from your traditional assets. So again, taxation, Roth paid up front, traditional, you pay your taxes at withdrawal. Now, as far as required distributions, what's the real difference here? So since these are prepaid tax assets on the Roth side, you're not required to take any distributions from your account. With the traditional assets at age 75, which there's different RMD ages, but for this age group, it will be 75 unless they change the rules again. But at age 75, the IRS is going to come knocking because they are assets that have not been taxed yet, and they're going to require you to pull out a certain amount each year so they can get their tax revenue. Now, let's talk about what happens when these types of accounts are inherited by a non-eligible beneficiary. We'll cover that in a few slides. But if it's not going to your spouse or an eligible designated beneficiary, all of the assets in these accounts have to be depleted by year 10. So let's say that with traditional assets and you pass away at 85. So your child might be 50, 55. If they're a doctor or a CEO or an attorney, they might be in their highest earning years. So anything that you pass on to them will need to be pulled out in 10 years, and it's just going to stack it on top of their tax bracket. So keep that in mind. I'll cover that again in just a few slides. In both of these types, there are what's known as qualified charitable distributions. Since you paid your taxes ahead of time with the Roth contributions, there's really no tax benefit to giving those assets away. But with the traditional assets, the tax deferred assets, if it goes directly to a 501c3, it would be tax-free to you. So it's potentially tax-free on both sides, tax deferred when it goes in and not pay taxes on when it comes out. Now, as far as how to allocate your assets in both of these buckets, I'm going to default to having you work with your advisor on this. What I see my clients typically do is when your assets are divided by your higher risk assets, your longer term growth, and your more conservative assets, we'll load up the Roth portion with the longer term, higher growth assets. Because, what do you want to grow more? You want your tax-free bucket at that point to grow the most. All right, next slide. All right, so why this screen? So in a couple of slides, we're going to be doing a side-by-side tax comparison of the inputs and outputs, and we really need to keep the math simple. So we're going to assume an 8% return each year. Do markets do this? No, absolutely not. But in the effort of keeping the math straightforward, we're going to make this assumption. So again, a consistent 8% return each year is not only implausible, but it's just straight up unimaginable. However, markets do tend to go up over time. So again, for the sake of keeping the math simple, we're going to go ahead and assume that 8%. All right, so let's look at an example. Let's use a nice round number. We're going to assume that you have $100 to invest. We're going to assume that steady 8% return over 20 years. And we're going to assume a tax bracket of 15%. So let's talk about the Roth contributions. You pay your $15 up front, grows over 20 years. You end up with $396.18, non-taxable. Now, if we do it the other way and you get your tax deferral up front, well, the full $100 goes in. That doubles over time at the 8% rate, and you end up with $466.10. So that sounds like the better deal, right? But if you're still in a 15% tax bracket, well, that's almost $70 in taxes, and you end up with the exact same amount. So mathematically, it looks like a wash at this point. So why even bother choosing? Now, remember the ancillary benefits to the Roth portion. No required minimum distributions. If you pass anything on to your heirs, it's tax-free to them. Maybe you're looking to keep your tax brackets lower in retirement for one reason or another. Or maybe you expect the tax laws to change and your tax bracket to be higher in retirement. It's better to take that discounted tax rate now. Let's look at that in table form. So you've got in the same tax bracket, 15% at distribution and contribution. $85 goes into Roth, $100 to the traditional. Value after 20 years, 15% on the distribution, $69.92 in taxes, and you end up with the exact same amount. Again, in this situation, Roth is probably better just due to those ancillary benefits that aren't tied to the traditional funds. Now, let's talk about lower earning years. Let's say your tax bracket is 15% now and 25% in retirement. Again, 85 goes into this one, 100 into this one, 8% growth. Here's the same values we arrived at on the previous slide. Tax rate at distribution. Now your taxes are $116.52, and it has made a lot more sense. You net more net of taxes with the Roth contributions. Let's look at the opposite scenario. $100, but your tax bracket right now, if you're in some higher earning years, is 30%. So now only $70 goes into your Roth. The full $100 goes into the traditional. Again, this is the same in every scenario. Value after 20 years. You've got a lower Roth value. Now, maybe your tax bracket in retirement is only 20%. Now your taxes are going to be lower. So if you're earning more now and in a lower tax bracket later, it may make sense to do traditional contributions. Okay, so I mentioned this in a previous slide, assets to non-eligible designated beneficiaries. So our industry is full of these acronyms. So for inherited IRAs, again, if somebody's a higher earner who is going to inherit your assets and they're forced to pull out all this money in 10 years, you may just be stacking that money on top of what they're already earning. Again, 10 years, they will have to pull that out, whether it's Roth or traditional. And the beneficiary may already become eligible for Medicare. We'll talk about Medicare brackets here in a minute. But if your child is 65 when they inherit these and they're forced to pay taxes on these accelerated distributions, it can really, really increase their Medicare costs later on. This is what it is, IRMA, another acronym, Income Related Monthly Adjustment Amount. So these are the surcharges that you will need to pay on your Medicare premiums if you go over certain income limits. And these are cliff brackets. That means if you go over by $1, they are going to push you into the next bracket no matter what. It is not marginal. And they look back 2 years. So if you're talking about Medicare expenses at age 69, it's going to look at your modified adjusted gross income at age 67. So let's look at these costs. Now, if you spent your entire life contributing the traditional style, and let's say that you're getting $4,000 a month in Social Security in retirement. You got some non-retirement earnings, dividends, and interest, and your required minimum distribution is $70,000 and you're single, you might be causing yourself to have to pay an extra $1,000, maybe $2,500 a year in Part B and Part D expenses. Now, again, these are the surcharges on top of the base charge. Currently, Part B for Medicare is $185 a month. Part D is probably around $37. But you can see how if you get into these next higher brackets, how much these Medicare costs accelerate. So if you're in your 40s and 50s, it's really going to be time to have a conversation with your advisor on how to limit this later on. You need to start thinking about this now. So those of you with large taxable balances in retirement, perhaps you're all pre-tax at the moment. What can we do to counter these later on? Well, there's a little something called Roth conversions. Now, you can convert a portion of your taxable assets to Roth at any point. There's just basically an agreement between you and the IRS that you're going to go ahead and prepay taxes, hopefully at a lower tax bracket, so that you're not taxed heavier later on. Now, the reason I don't have any practical examples here is, while the basic math involved for the inputs and outputs is going to be the same for everyone, no one's true financial planning situation is going to be alike. So I don't want anyone just overgeneralizing this information and maybe making a mistake and converting their entire pre-tax balance in their 401k to Roth and find themselves in a desperate tax situation. So again, work with your advisor to see if these are right for you. So, like I said, Roth conversions aren't a solution for everyone. I'll give you one example. So I've got a client who he's approaching 60 years old. My neighbor's doing these, massive Roth conversions. Is this going to be right for me? I tell him no. You don't want to do any Roth conversions in this scenario. He's got plenty of non-retirement assets to live off of. He has no children. He has no one he wants to pass it on to. He's going to be doing massive qualified charitable distributions later on. So I'm telling him, you haven't paid any taxes on it yet, and we can avoid taxes on it now if it goes to an appropriate charity. So why pay taxes at all? So that's why I'm not giving any practical examples here. I don't want somebody screwing up their retirement portfolio and finding themselves in a massive tax situation when it is, completely unnecessary. And once it's done, it's done. It used to be you could recharacterize if you made a mistake, but no longer. So if you're wondering if this is right for you, I strongly urge you to work with your advisor on this. Now, I mentioned qualified charitable distributions. Here are just the rules. It has to be made to a 501c3. It has to go directly to them. It cannot hit your bank account or the deal's off. You have to be 70 and a half or older. Currently, the amount you can do is 108,000. Anything beyond this will be taxed as ordinary. It can offset your RMD fully later on. You cannot receive anything from the charity in return. And sometimes you need a written acknowledgement to give to your tax preparer. So keep that in mind. All right. So that is it for Roth and traditional contributions. Let's talk real quick about health savings accounts. So this is a potentially double tax-free asset. If you're covered by a qualified high deductible plan, and you're not currently enrolled in Medicare, and you can't be claimed as a dependent on someone else's tax return, you can contribute to a health savings account that goes in pre-tax. It grows tax deferred, and as long as it's used for qualified expenses, it will be tax-free. So double tax benefits for HSAs. Now, the limits are lower on this because they're not going to give you too much of a break. Currently, for a family, if you're under 55, it's $85.50 a year. If you're 55 and up, it's $95.50 a year. But if you have this available, I strongly suggest using it because let's look at everything it can be used for. It can be used for out-of-pocket expenses, co-pays, hand sanitizer, exercise equipment, sunscreen. Yes, sunscreen and chapstick as long as it's SPF 15 or higher. Look at this. It can be used for Medicare premiums later on, tax-free. Air conditioner. Yeah, I mean, landlords have to provide air conditioners these days because it's no longer considered a luxury. If you need an AC, your doctor's going to sign that letter. It's called a letter of medical necessity. You can use tax-free assets to pay for a new air conditioner. It can also be used for long-term care premiums. This is going to be my last session. I'm already at 20 minutes. I'm going to try to wrap this up. So you can contribute up to age 65. You don't want to pull these out and use them for non-qualified medical expenses before 65 because if you're in a 30% tax bracket, you're going to be taxed at 30% plus a 20% penalty. You're going to lose 50% of every dollar. Now, using funds for non-qualified expenses, if you're over 65, there's no penalty. It's ordinary income, so it's essentially like an additional IRA. But if you've got 75 grand in an HSA and you're 65, you're going to use all of that. The other thing that I want to talk about is not using it. So let's say you're 65 and you've got $150,000 in an HSA. You're going to want to start using it. The reason that is that it doesn't, if it gets passed to anyone other than its spouse, it is taxed 100% at their tax bracket the day that you pass away, and there's nothing you can do about it. So you're going to lose that tax deferral and the tax-free distribution of it all in one swap. So if you have an HSA and maybe you're 70 years old, just start using it. You don't want to lose those tax benefits. And now I will turn it over to Adam.
Awesome. Thanks, Brian. Great job. Hi, everyone. I'm Adam Hutzel. And today I'm just going to take a few minutes to share some quick tips on how best to utilize 529 plans to pay for college, as well as how to best navigate the FAFSA application. So in part one of this planning series, Planning in Your 20s and 30s, the presenters touched briefly on establishing accounts, basic function of 529s, but I do get a lot of questions from my clients in their 40s and 50s on how do I actually use these funds to pay for college once my kid's been accepted to a university. So on this first slide quickly, what is a 529 plan? Well, it's named after the section of the code it's codified under, which is section 529 of the Internal Revenue Code. Basically allows you to establish a tax advantage savings account utilized for education expenses. And as long as we are utilizing the funds in the future for qualified expenses and qualified withdrawals related to education, all of the earnings grow tax-free. So it functions similarly to a Roth IRA for retirement. And this can actually be used to fund K-12 education, college, and even repayment of student loans in some cases. One quick tip, and this is the first tip here on 529 plans, is that you are able to lump together 5 years of gifting into the plan equal to this year's annual gift tax exclusion. So for example, this year for an individual, that number is you can put 95,000 per student in if you're an individual, or 190,000 for a couple, and really turbocharge those college savings plans without incurring any gift tax consequences. So I see this come into play a lot with grandparents wanting to give larger gifts to their grandchildren. So that can be a great tactic to utilize in those situations. So what are the qualified uses for 529 plans? Well, on the left, you can see we can apply these towards college expenses, such as tuition, fees, books, supplies, towards room and board. And this comes up a lot. Yes, you can utilize it for computers and internet access for the student, and some other supplies apply there as well. You can also apply up to $10,000 a year towards K-12 education, such as private school tuition. And then also, there is a scholarship offset provision, which means if your child does receive a scholarship towards college, you can actually withdraw from your 529 up to the amount of the scholarship penalty free, and then use those funds for whatever purpose you see fit. So the big non-qualified expense that I get asked about all the time is transportation. So things like plane tickets to and from school, car expenses, parking expenses, etc. Those are all non-qualified expenses. And along with health insurance, extracurricular activities, these are all going to be subject to a 10% penalty plus income tax on any earnings inside of the account that's been withdrawn. So on the next slide here, the best way to coordinate utilizing these 529s to be as efficient as possible on the FAFSA, you can see on parent-owned 529s, these count as a parental asset, and we'll cover these in just a moment, what percentage counts towards that FAFSA application. And for those of you who don't know what the FAFSA is, don't worry about it. I'll cover that in just a second too. But it's a good idea to spend those assets owned by the parent 529 down earlier in college to reduce aid impact later on in college. Grandparents, if they're the ones that own the 529 plan, this is not reported at all on the FAFSA, so you can let those continue to grow and maybe use those in the student's junior and senior years. And then really, if possible, avoid having your 529 plans owned by the student, as their impact and the amount that that's charged for on the FAFSA application are going to be higher than their parents. So on this next slide here, if you do end up with funds remaining at the end of school, if you still have funds remaining in the 529 plan, if you just want to go one more, Brian, thank you. You have a few different options where you can change the beneficiary to another qualified family member. Typically, this is going to go by lineage. You know, you could use it yourself. You could change to another kid, to grandkids. Number two, you can use up to $10,000 to pay for any lingering student debt, or recently added in the Secure Act 2.0, you do have the option now of rolling over. You need to meet Roth rules where the kid needs to have earned income, and you can only do up to the max per year, but you can roll over time up to $35,000 from the 529 into a Roth IRA. So that's become a really cool feature now if those funds are not utilized through school. And so what is the FAFSA? I've mentioned this a few times now. So first off, it is a free application for federal student aid. So there's really no reason, if you have kids in college, not to fill this out every single year. Even if you don't think you're going to qualify, there's a lot of plans. There's grants, work study, student loans, state and institutional aid, and a variety of others that you may end up qualifying for, may be applicable in your situation. So it is worth the time to go ahead and file those every single year. And if we go to the next screen here, what's the timing look like? It's always going off of 2 years ago. So there's a 2-year lag. It uses information from parental and student tax returns looking back 2 years. So for parents that were applying for this fall, they were using the 2023 tax return. So any returns that are filed in the student's last 2 years of school, those won't affect any FAFSA or any aid awards at all. So this information is then all put together. It determines the families, you're going to hear this term a lot, SAI or Student Aid Index. This judges parental assets and income, student assets and income, how large your family is, and how many kids you have in school or college at the same time to determine what programs you actually end up qualifying for and what amount you are going to receive from those various programs. So on this next screen here, how are these impacting things? Like I said earlier, student assets have much more of an impact than parental assets do. So for parental assets, they're including bank accounts, 529s, trust accounts. These are all going to be counted at 5.64% of their value. And income is going to be in a range. It's somewhere between 22 to 47%. But for student assets, you can see they're significantly higher. So they're UTMAs, accounts that are in their name only, those are all going to be counted at 20% of the value, as opposed to the 5.64% for their parents. And their income is going to be a flat 50% counted towards the FAFSA, as opposed to that range of 22 to 47% for parents. So a quick note, custodial 529 plans are not treated as student owns for the FAFSA. So if they're custodial owned, if they're parental owned, they're grandparents owned, none of those are going to be problematic. So just try to keep the 529s out of the student's ownership. And what are some of the things that are not counted on the FAFSA? That's going to be retirement accounts. That's going to be home equity in your primary residence. Life insurance and annuities are not counted. Family-owned businesses and farms with certain conditions for farms are not going to be counted, as well as any of your personal possessions. So this part's very important. Aid is often awarded on a first come, first served basis. So it's worth looking up or consulting with your advisor as to when the application open enrollment period is, and to be one of the first people to get it in there, because sometimes, again, it is on a first come, first served basis. But overall, realistically, when you're getting close to college, you have children that are entering that age, this presents a tremendous planning opportunity to maximize your efficiency on utilizing those funds that you spent 18 years growing. So make sure you are consulting with your advisor, and we'll make sure that we are on our side hitting all the items that we discussed. And I'm going to have now turn it over to Michelle Postone to wrap things up with a look at protecting your income, family, and legacy.
Awesome. Thank you, Adam. It was very helpful, especially for those of us having kids going into college soon. All right. So as you said, I'm going to make a little bit of a shift now, talking more about protecting yourself. So another term that we like to use for this is risk management. And the most strategic tool for risk management really is insurance. The first one that I'd like to touch on is life insurance. So when you purchase a life insurance policy, very simply put, you are buying a policy that when you pass away, there's a lump sum of money that goes to your loved ones, your beneficiaries on that policy. And a lot of people in their 40s and 50s are in a situation where they have a large amount of expenses, and so they could need some additional life insurance. It could be for covering funeral costs, debts, especially a mortgage. That's usually a large part of a budget. And so that could provide some cash flow relief for a surviving spouse if that mortgage is paid off on if the other spouse passes away. Funds for your children. So let's say if you do unfortunately pass away before your kids have college expenses, maybe they have a wedding cost, they'll have a first time buying a home. And so you have the ability to leave them some assets to be able to help during these, large financial purchases that they have. Income replacement is another very powerful asset for a surviving spouse, especially in households where if you guys are equal earners, a 50% decrease in income is very large. And then if you swing the other way and you have someone who's actually earning more than 50% or is the main breadwinner and that income is gone, it could leave the surviving spouse in a very tough financial situation. And so life insurance can give them a bucket of money that they can invest in the market, and they can use that as income replacement, income supplement. So they can try to continue to live that same quality of life. The proceeds are paid out tax-free, which makes a very tax-efficient way to transfer assets. And there's also options for charitable giving. So if you are inclined to charitable giving or want to have a legacy for leaving, some sort of foundation, for some sort of, possibly going back to school or scholarship, whatever that might be, you have the ability to leave money to charities as well. So there are a variety of life insurance products out there. They usually narrow down to two basic type of products, which is either going to be term or permanent. So term insurance is going to be where you choose the amount of time you want that coverage, typically 10 to 30 years, and you pay that premium for that entire amount of time. And as long as you pay that premium, you have the coverage. But at the end of that term, the coverage goes away. It's important, though, a lot of times to have this during this time of life, because as I just talked about, your expenses are probably larger. You might have children that would need financial help, a mortgage to be paid off, income replacement for that spouse that we talked about. And so the term is nice because hopefully, as you are saving more in your retirement accounts, you're building your portfolio, your kids are hopefully able to take care of themselves as they grow up, you get your debts paid off, you won't need as much life insurance. And so term is going to be lower cost than permanent insurance. So it's a great tool to use for that time of life when you need a little bit more. All right, and then permanent insurance is going to be what it sounds like. So you can have that for the rest of your life. You have a premium that you're going to have to pay as long as you have that policy. But a portion of that premium goes into a cash bucket of money, a cash value bucket. And so that makes the premium higher because they take part of the premium and they put it towards the cost of insurance. And then they take the other part of the premium and put it in that cash bucket, which can be invested in the market. And so that cash value builds over time. And there is a possibility, it just depends on the product, how much premium you're putting in, what age you start it, but there's a possibility that those permanent policies can start to pay for themselves, meaning you could still have the coverage, the cash value pays for the premium, and you no longer have to put premium in. They can be a really strong tool for people who want to transfer wealth, no matter when they pass away, they want a certain amount of wealth to transfer on. Again, charitable giving legacy, if that's really important to you. It can be a strong estate planning tool as well, which we'll dig into a little bit more later. But really, if you have any even if you just say, I want at least $50,000 for funeral costs and whatever other general costs there may be with my passing, you can get a permanent policy for that. So just whatever you would always want to have a certain amount of insurance for, these permanent policies are great for. And then we can also use life insurance for business purposes. If you want to go to the next slide, Brian. Thank you. On the business side of things, this can be a really powerful tool if you're a business owner. You can create a legal agreement, like a buy-sell agreement with someone with, like, let's say you have a partner or maybe a brand new owner that it could be if you're to pass away. But that life insurance allows you to have a lump sum of money paid out on your passing. And so that's how that person, those assets they need to purchase the business so that they can financially do that on your passing and they don't have to come up with those funds themselves. The life insurance can also provide coverage for a key person. So a key person policy is going to be, let's say you have an employee that's very important to your business, especially financially. And if they pass away, it could put your business in a negative financial situation or just could be a really tough transition for a little while. So it allows you to take out a life insurance policy on this crucial employee or an owner, and it provides that financial safety net in the event of their death, and it gives the business time, to mitigate those financial losses and get through that transition without hopefully too much negative impact. All right. Now we're going to switch to another type of insurance, which is long-term disability. And I will tell you that long-term disability is an area where I see the biggest probably gap in people's financial plan. A lot of people don't think about it. And so for long-term disability, what this does is it's going to allow you to get a portion of your income replaced if you can't work due to illness or injury. If you are employed, there's usually a group plan. Not all employers, but a lot of employers have a group plan likely. And so you might have coverage through a group plan or have the option to. If you are self-employed, that's again, a lot of where I see a gap in plans is with my business owners and not having long-term disability coverage. So if you're self-employed, that's something you have to go work with an advisor and get a personal plan to cover yourself. If you are ill or injured, you have to wait usually 60 to 90 days before the coverage does kick in. So they want to make sure it truly is a long-term issue that you have. And then once it kicks in, you get, again, a partial income replacement. And depending on the type of policy you have, this could be several years of coverage all the way up to retirement age when you start taking Social Security. Now, Social Security and how that affects the benefit depends on the type of policy you have. So if you have a policy and you want to know how it affects it, you would need to ask that question to the financial institution or your employer, to your HR department. If you are getting a policy on your own, that's a good question to ask, is how will Social Security affect this policy when it kicks in? Because it's likely you might be able to get disability, Social Security as well, if you really are, disabled and unable to work. You are statistically more likely to become disabled than pass away in your 40s and 50s. And you can go to the next slide, Brian. And so your income is one of your largest financial assets, and the loss of that could be a major financial setback for your family. And a lot of times, if you are having health issues or an injury, there could be increased health costs as well. And even with a really strong emergency reserve, emergency savings, it's not often enough to replace, the rest of your life that you might have ahead of you to cover those costs. All right. So the next one I want to jump into, I'm trying to be quick here so you guys have time to do questions at the end. So please ask questions if I go too quick, is estate planning. And estate planning is another essential part of an overall financial plan. And it's more than a will. So, don't think, oh, I have my will, my estate planning is done. A will is important to have. It states who you want to distribute your assets to at your passing. It also can name the guardian of your minor children, but it does not avoid probate. And so probate is the process of transferring your estate through the court system, which means it is public information, it's lengthy, it's costly, and it's just honestly a general pain. So you want to avoid probate as much as possible for your loved ones who will be left to deal with that. And so one of the easiest things you can do to avoid probate is to have direct beneficiaries on all of your accounts and assets. So if it has a monetary value, if it has a title to it, you can add a beneficiary, you can add a transfer on death, you can add a payable on death, is what they call it at a bank. So yes, even your checking and savings accounts. So anything really with value, you want to make sure you have that listed on there. And that's the most efficient way to make sure your assets pass to who you want them to go to outside of probate. Now, there are other documents that are important to consider that I like to call living documents. And so you can get a living will, and that outlines like what medical things you do or don't want to be done if you are having major medical problems, like on life support. A healthcare power of attorney. So let's say that you are in a coma and you can't make your healthcare decisions. Well, the healthcare power of attorney allows you to decide who's going to make those decisions for you. A durable power of attorney is the same idea, but with finances. So if you can't take care of your finances, someone can step in, your durable power of attorney, and make those financial decisions for you and can take care of your day-to-day finances. And then if you start to get maybe in some more complex situations, a trust can come in handy. One of the most common ones that I see for clients, especially in the 40s and 50s, is that you probably still have, or you may still have minor children. And what happens when there's a minor child is that whoever the guardian is of that child would be in charge of those assets that they would inherit until they reach age of majority. And in most states, age of majority is 18. And most clients I talk to don't feel comfortable with their kids at 18 receiving a large amount of money that they would be able to, manage that well. And so a trust can allow you to decide who's in charge of that money, not just until they're 18, but whatever age you decide, when they can use the money, why they can use the money, how they can use the money. And so it really allows you to put guidelines in place, and that trustee that you decide who's in charge of that, they have to go by those guidelines. All right, next slide. So again, a trust might make sense if you have accumulated a large amount of wealth and assets. It's not the only time though. I think that some people think, oh, I only need a trust if I have, a high net worth. But there are additional times like minor children that we talked about. There could be special needs planning. If you have a special needs person that you want to give financial assets to at your passing, you can do that through trust and it won't affect maybe any kind of governmental assistance that they're receiving. Blended families. If you're in a situation where the guardian, your children, you may not want them to be in charge of the finances, again, that trust can be put in place to where you can say who's in charge of that money for your children, and you can decide who gets it and when they get it. And so blended families, it can just be a little extra protection to make sure your money passes as you want it to. It can help avoid family conflict. Unfortunately, when people pass away and there's a lot of grief and emotions, family conflict can arise. And so the more you can have these things laid out, the better to try to avoid that. And it's important if you get a trust to fund your trust. So it can't avoid probate unless you put everything through that trust that is supposed to go through that trust, and your estate attorney would help you with that. But that's an important part that a lot of times we see some people forget. All right. There are some advanced strategies that can allow for high net worth people around estate planning. And so that can be around gifting to try to gift it out of your estate, or just if you have a desire to gift, trying to minimize taxes and more. This I'm not going to dive too deeply in because, again, I want to leave time for questions. It gets a little bit more complex. Right now, your total lifetime estate exclusion for gifting is 13.99 million each. So you have to have a pretty high net worth to get to that point.
Michelle, do I need to go to the next slide? I'm sorry to interrupt.
Yes, please.
There we go.
Yes, thank you. And so I was just going and didn't think about it. And then that raises to 15 million in 2026. Right now, it could change. It could go down in the future, but it doesn't currently look like it's going to in the short term. But that's something to keep an eye on, because if that changes, it might change for your personal situation, how you need to plan towards taxes and gifting, etc. This one on the bottom, oh, and then the annual amount, sorry, is $19,000 per person. But that doesn't mean, let's say that you want to give someone $25,000. Well, you can just file with the IRS and say, I did above my $19,000 to this person in gifting, and they just put it towards that estate, that total estate amount of 13.99 million. And so there's no taxes that have to be paid that year. You just have to report it. An irrevocable life insurance trust. This can be it's a great strategy. It is complex. The simplest way to put it is to have your life insurance go into an irrevocable trust, and then that can pass on to the next generations. And it's not included in the estate, so it's not taxed because it's that life insurance benefit. But there are some very specific rules around that. So that's something that if you're interested in, you'd want to talk to your advisor about. All right, next slide. To just summarize, I encourage you to review your life insurance, make sure that you have enough for your goals, review your long-term disability coverage, review and make sure that you have direct beneficiaries on all your accounts and that they're how you want them to be, who you want them to be. If you don't have estate planning documents, get them in order. I know it's not a fun process, but it's very important. Revisit them every few years. So if it's been a while, you might want to revisit your estate documents and see if you've had any life changes that could change what you want to do. And then again, just keep an eye on tax laws and how they could affect you, and your advisor could continue to help you with that. All right. We've got about 9-10 minutes for questions, and I'm sure we can hang on a few extra minutes if we need to. You're welcome to either raise your hand, unmute yourself, and we can field those. Let's see. I thought I saw a raised hand, but then did it go away, Lauren? Kevin? Can you unmute yourself? I don't know that I can.
Am I there?
Oh, there we go.
So I have will be a high school senior. As far as the FAFSA goes, when should you first apply for it? And then obviously the ongoing years, when should you continue to apply that as far as for the upcoming school year?
I would have to get back to you, and Kevin, I can actually take down your information and get this information over to you. I believe the window opens in the spring prior to the fall semester, and then you're just going to want to each year, assuming that he goes for 4 years, then for 4 years in the spring, you would file it kind of as soon as they release the FAFSA, because they update it and some of the information changes slightly year to year. So I'd suggest just working with your advisor. Like I said, I'll take down your name here and I'll make sure that that information reaches you. We could actually send that out as well, but I believe it's this spring, sometime in April, but I'll have to verify on that.
Yeah, was it this year or last year, Adam? If you know, like the entire FAFSA application system was down. There was folks trying to get their applications in February, and they kept getting kicked out. There was a huge debacle in 2024. I think they've got it straightened out, but I do think it's right at the beginning of the spring. I could be wrong. My kids are itty bitty right now, so I don't know.
And Kevin, just to repeat, you definitely want to just do it every single year because your results and your assets and your income are going to change over time. So each year you might qualify or be disqualified again for certain, grants, aid, programs, so on and so forth.
Sure. Okay. I appreciate it.
Absolutely. Okay, well, I think if there's nobody else, I think on behalf of all of us, we just appreciate you taking an hour or so with us. These are all very complex topics, like Brian was alluding to. We're kind of running through these in about as high level detail as we can, just to preserve some time and give you back a little bit more of your day. We don't want to bore you too much, but if there's any of these you want to dive deeper into, obviously feel free to reach out to your individual advisor. They're well trained on all these areas as well, and they'd be happy to go and do a deeper dive than anything that we're doing here. Make sure that whatever situation or product or direction is most pertinent to your situation is the one that we elect.
Great. All
Thanks so much, everybody. Hope you all enjoy the
Thank
rest of your day.
Thank
Have a
you
wonderful
all.
day.
Enjoy the summer weather this week. Take care.
Yeah.